Welcome to our video where we delve into the intriguing world of tax-savvy business tactics, where trust-like benefits are given to limited company directors. At first glance, these two entities might seem quite different, and indeed they are. A limited company is a distinct legal entity, typically formed for the purpose of carrying out business operations. It is a separate entity from its owners and has its own rights and responsibilities. On the other hand, a trust is an arrangement where assets are managed and distributed for the benefit of specific individuals or entities, often to secure future financial security or to manage wealth. While these two entities have unique structures and purposes, it's fascinating to explore how a limited company can be tweaked or utilized to provide certain benefits akin to those associated with a trust. So let's dive deeper into this conversation and explore how we can make the most out of these financial structures. Imagine a scenario where a limited company is established as a family investment company for a group of friends. Let's meet Alice, Bob and Carol, three friends who decide to pool their resources to create a family investment company, which they call XYZ Limited. They each take on dual roles as shareholders and directors of this new venture, holding a stake in the company they've just formed together. Just an FYI, one person can also create a company and be the sole director of the limited company. As they embark on this journey, they collectively transfer their assets, be it investments, money or real estate, to XYZ Limited. They could also offer their services as sweat equity to the company. This could be in exchange for shares in the company, marking an important milestone in their journey. With this step, the company becomes the legal owner of these assets. It's a significant move, laying the groundwork for income generation and potential tax advantages. But remember, this is just the start of their story, and there's plenty more to discover about the workings of a family investment company. Now, let's dive into how XYZ Limited generates income and how dividends are distributed. Imagine XYZ Limited as a bustling marketplace where assets like investments and real estate properties are its shops. These assets, transferred by Alice, Bob and Carol, are the lifeblood of the company. They generate income much like shops earning profits from selling goods or services. For instance, if XYZ Limited owns shares in other companies, it earns dividends. If it owns real estate, it collects rent. Now picture this income as a river flowing into the company's coffers. As the river swells with profits, the company, directed by our trio of friends, decides to declare dividends. This decision to distribute dividends is a bit like opening a dam and allowing the water, or in our case the profits, to flow out to the shareholders. Here's where the magic happens. Alice, Bob and Carol, as shareholders, each have a bucket. The size of their bucket, or the number of shares they hold, determines how much of the dividend water they collect. If Alice holds half of the shares, she gets half of the dividends. If Bob and Carol each hold a quarter of the shares, they each get a quarter. It's all proportional, fair and square. But there's one more twist. Dividends, unlike salary income, are typically taxed at a lower rate. So when Alice, Bob and Carol collect their dividend water, they get to keep more of it. It's a bit like having a more efficient bucket that doesn't leak as much. This potential tax advantage makes dividends an attractive form of income for many investors. Remember, tax laws can vary, so it's important to consider the specific tax regulations in your area. And like any river, the flow of dividends can change. So it's crucial to keep an eye on the marketplace and adjust your strategy accordingly. But with careful management and a keen eye for opportunities, our trio of friends can keep the river of income flowing and their buckets brimming with dividends. Alice, Bob and Carol aren't just shareholders of XYZ Limited, they're also in control. As directors of their family investment company, they helm the wheel of their shared fortune. They make decisions from the minor to the major, guiding the course of their collective wealth. Even decisions on medical scheme and retirement contributions that the company pay as a benefit on behalf of the directors. These decisions on company benefits, salaries and expenses to be paid by the company will form part of the responsibilities and control of the directors. It's also about managing their assets. Say, for instance, they decide to invest in a promising startup or sell a piece of real estate. They have the flexibility to make these decisions collectively, keeping the reins of their financial future firmly in their hands. But what happens when one of them is no longer around? Here's where estate planning comes into play. Each friend's shares in XYZ Limited are not just units of ownership, they're also a legacy. Should Alice, Bob or Carol pass away, their shares can be passed on to their heirs. It's a way of ensuring that their wealth continues to provide for their loved ones, even when they're no longer around. This isn't just about preserving wealth, it's about minimizing the impact of inheritance tax. By passing on shares rather than assets, they could potentially reduce the amount of tax their heirs would have to pay. It's a way of making sure that the fruits of their hard work benefit their loved ones to the fullest extent possible. But let's not forget about flexibility. The structure of XYZ Limited allows Alice, Bob and Carol to adapt to changing circumstances. They can adjust their shareholdings, manage their assets, and make decisions that align with their long-term financial goals. It's a structure that's built for the future, designed to weather changes and withstand the test of time. But there are also other benefits to consider. The limited company can enter into legitimate rental agreements with its directors, but these transactions must be conducted at arm's length, meaning they should be fair and reasonable, similar to transactions with unrelated parties. Here are some examples of what a limited company might rent from its directors. Residential property or vehicles owned by the directors that are used for business purposes. Even portions of a building or specific mileage of a vehicle can be rented. While setting up a family investment company can have its benefits, there are important considerations to keep in mind. First and foremost, it is essential that you consult with tax professionals. They can offer invaluable insight into the tax implications of your decisions and guide you towards maximizing tax efficiency for your group. Tax laws can be complex and vary greatly, so having a knowledgeable professional on your side can make all the difference. In addition to tax considerations, you must also pay close attention to the legal structure of your family investment company. This structure should be carefully crafted to align with your group's financial goals and comply with local regulations. This is no small task, and it's one that may require the assistance of a legal professional. Remember, a family investment company is a legal entity, and as such, it comes with legal obligations and responsibilities. It's important to understand these fully before embarking on this journey. Furthermore, make sure the structure of your company allows for the necessary flexibility. Life is unpredictable, and your company should be able to adapt to changing circumstances. This flexibility can be crucial for long-term financial planning and the continued success of your family investment company. Lastly, don't underestimate the importance of clear communication and agreement among all parties involved. All shareholders and directors should have a clear understanding of the company's structure, their roles and responsibilities, and the financial implications of their involvement. While the process might seem overwhelming, remember that the benefits can be substantial. A well-structured family investment company can provide a centralized control over shared wealth, potential tax advantages, and increased flexibility in financial planning. We hope this video has shed light on how a limited company can provide benefits similar to a trust. If you found this video helpful, please give it a like and leave a comment below. If we've earned your support, we'd appreciate it if you could subscribe to our channel. Thank you for watching.